Hello, and welcome to a webinar introducing our long-awaited new standard, IFRS 17 insurance contracts. My name is Andrea Pryde. I'm the project lead for the IASB, and with me is Darrel, the lead board advisor on insurance contracts. Before we start, though, a few pieces of housekeeping. You can download the slides that we are going to present by clicking on the button below the slides window. We will be taking questions during the presentation, and to ask a question, you need to type in the designated text box on your screen and click Submit. There will be a recording of the webcast available after the presentation on the project pages. And finally, the views expressed in this webinar are those of Darrel and me, and not necessarily those of the IASB or the IFRS Foundation. So this webinar is intended to be a high-level introduction into IFRS 17. There have been other webinars and there will be further presentations in the future. We will go into some of the detail, but for today we're really focused on what is IFRS 17, who's going to be affected, what are the main changes, when will people need to apply IFRS 17, and then some links for further information. At the end, we hope to take questions from you, so please keep those questions coming in. So, starting with what is IFRS 17. It's the first truly international comprehensive accounting standard for insurance contracts. It replaces IFRS 4, which was the previous standard for insurance contracts, and when introduced in 2004, that standard imposed limited specific requirements because it was deliberately intended to allow for the continuation of many existing insurance accounting practices. That meant that IFRS 4 allowed insurers to use different accounting policies to measure similar insurance contracts that they wrote in different countries. And because some of the practices currently used by those companies evolved in tandem with circumstances which were specific to those countries, this meant that the practices often only addressed insurance products that were most prevalent in a particular country, perhaps drew from regulatory accounting, and in any case, the features of those accounting models were often inconsistent with the IFRS standards applied by other industries in the same country. And what that's meant is that the comparisons between insurers in different jurisdictions was made very hard for investors, and comparison with other industry sectors was also very limited. IFRS 17 sweeps that away. As a result of IFRS 17, companies will be providing updated information about the obligations, risks and performance of insurance contracts, and that will lead to increased transparency in financial information reported by companies, and that in turn will give investors and analysts more confidence in understanding the insurance industry. The model in IFRS 17 introduces consistent accounting for all insurance contracts based on a current measurement model rather than basing information on historic information, and it will apply principles that are consistent with other industries. So, passing to Darrel.
Thanks, Andrea. I guess this is probably the most important question in the standard, and I expect that we might see a few people log off the call once we get through this. And the question is, who's going to be affected by IFRS 17? IFRS 17, like other IFRSs, is focused on insurance contracts rather than being focused on entities themselves or industries. So when you look at IFRS 17, it essentially applies to everybody that issues insurance contracts. That said, obviously the biggest issuers of insurance contracts are the insurance industry themselves. And so that's where we would expect the biggest impact of the standard to be. The industry fills a central role in the global economy. Insurers obviously enable the transfer of risks, but are also significant long-term investors. And as such, having looked at these numbers from our perspective, we've identified that insurers, listed insurers, applying IFRS invest in about $13 trillion of assets. And that accounts for about 12% of the total assets of companies that are applying IFRS. So this is a significant industry that plays a significant role, and the effect is likely to be fairly substantial. Given this central role, though, the IASB strongly believes there's a need for long-term stability and for proper international accounting and transparency in the space. I mentioned earlier that the standard scopes in all insurance contracts and consequently will include companies that are not previously regarded or not generally regarded as insurance companies. However, it is worth saying at this stage that IFRS 17 does include some scope exceptions, and these scope exceptions will primarily affect entities that are not in the insurance industry. So the standard excludes from its scope ordinary product warranties issued as part of sales transactions, so issued perhaps by the manufacturer of a product or the dealers of that product or a retailer. It also excludes some financial guarantee contracts, and the standard also scopes out fixed fee service contracts. Now, a fixed fee service contract is essentially a contract where the service provider agrees to provide an uncertain future service in return for a fixed fee. And although that has some of the elements of an insurance contract, it would be excluded from the application of this standard, and by choice an entity can look to apply IFRS 15 to those transactions instead. So what is changing? The information provided by IFRS 17 provides transparent reporting about a company's financial position and risk, and about its performance over time. You can think about this in three distinct pillars, or as we presented on this slide, in circles or bubbles. The first of those pillars deals with the value of the insurance obligation itself. Under IFRS 17, an insurer measures insurance contracts using updated current estimates and assumptions that reflect the expected future cash flows, the timing of those expected future cash flows, and any uncertainty related to the cash flows. These measurements are based only on the obligations created by the contracts themselves. Any separate investment portfolios that insurance companies held, even if they are directly related to the underlying insurance obligation, are measured separately. And this allows the standard to highlight any discrepancies between the asset strategy pursued by the entity and the obligations created by the contracts it's issued. So moving on to the second circle, the second bubble, this deals with insurance revenue, specifically the recognition of revenue by an insurer. We've heard in many spaces in IFRS that revenue is a really important metric for all entities, no matter what type of contracts they issue. And IFRS 17 essentially brings revenue recognition principles that are applied elsewhere in IFRS into the context of insurance contracts, so to align those principles for all types of transactions effectively. In general, when you look at the underlying insurance contracts, what you generally find is that premium cash flows are driven by a variety of considerations and frequently include investment elements, in addition to the core risk elements that we would consider as part of a normal insurance contract. The pattern of premium flows is also often not reflective of the pattern of the service delivery of an insurance contract. Consequently, under IFRS 17, we've addressed both of these issues. We change premium flows to eliminate the effect of any investment flows that are inherent in those cash flows, and we make sure that revenue reflects the delivery of the service over time, that same pattern of delivery, rather than reflecting the underlying cash flows. And this brings the treatment of insurance in line with the treatment of other types of transactions and contracts. The third of the bubbles deals with performance, specifically profitability and how an entity reflects its profitability. IFRS 17 requires companies to provide consistent information about the drivers of current and future profits that they reflect in their results, but also provides information about how those profits are expected to be delivered in the future. This provides metrics that allow users of financial statements to better evaluate the actual performance and how that performance has changed over time. We specifically separate out underwriting activities, which are described in the standard as the insurance service result, from the investment result, because we believe although both are core drivers of profitability in insurance, they are driven by very different economic and strategic considerations. The effective date of IFRS 17, it comes in from January 2021. Companies can choose to apply the standard before that date, but only if they have also chosen to apply IFRS 9 or already been obliged to apply IFRS 9 on financial instruments and IFRS 15 on revenue standard. IFRS 17 includes several transition reliefs to assist a company in applying the standard for the first time. So, for example, a company that is not required to account for its insurance contracts, as if IFRS 17 had always been applied, if that is not practicable. Instead, in that circumstance, a company can use one of two approaches: a modified or simplified retrospective approach, or a fair value approach. IFRS 17 also considers the fact that for some insurance companies, they may have adopted IFRS 9 before they adopted IFRS 17, and consequently allows those companies to reconsider the decisions and classifications they made under IFRS 9 based on the facts and circumstances as required by IFRS 9 that exist when IFRS 17 is applied for the first time. And with that, I'll hand back to Andrea.
Thanks. So many of the concepts in IFRS 17 might be new to companies, and some of the requirements in IFRS 17 are complex. We expect that companies will incur significant operational costs applying the requirements in IFRS 17 for the first time, including the development of new or existing systems. The diversity in existing practice means that companies will approach the transition to the new requirements from many different perspectives, and that's because IFRS 4 essentially grandfathered any national gap that existed at the time that IFRS was adopted. So we think that that means it's particularly important in this case that we support implementation through a variety of activities. So in addition to the materials accompanying IFRS 17, which is the basis for conclusions and the illustrative examples, we plan to make available webcasts introducing this standard and focusing on specific requirements, and a number of other materials for investors, regulators, and standard setters. We've also decided to establish a transition resource group, or a PRG as most people seem to refer to it, and that's intended to be discussed for the purpose of discussing possible implementation issues. We expect that the PRG will discuss questions from stakeholders about the new accounting requirements in IFRS 17, and its main purpose is to provide a public forum for stakeholders to follow the discussions of questions raised on implementation, to inform us in order to help us to determine what, if any, action we might take about these questions, such as providing more supporting material, or providing some case studies, or perhaps even referring to the board or interpretation committee. We have got live at the moment a new IFRS 17 implementation page on the IFRS Foundation website, and this page will be updated regularly. It will provide access to all the webcasts and supporting materials, documents prepared by us for discussion at public meetings, information about the transition resource group, as well as the call for nominations for that group, and then also information about conferences focused on the implementation of IFRS 17. If this webinar has made you want to find out more information about IFRS 17, we've got a number of resources already available on our website. I've mentioned IFRS 17 in the basis and the illustrative examples. They're available for IFRS subscribers already. The effects analysis describes the likely costs and benefits of IFRS 17, and that's really available on the website already. We've got a project summary, which is a brief overview of the project to develop IFRS 17, and a feedback statement which summarises the feedback on the proposals that preceded IFRS 17 and explains how the board responded. In addition, we have a higher level overview video in which Hans Hugovoss introduces the new standard, and a fact sheet which summarises a few of the essential facts. So thank you for listening to this webinar, and we will turn now to the questions. Darrel, is there a question you'd like to ask?
I'll pick up on the first one or two questions that have come through. I think the first one relates most recently to the slide that you've just presented, which is when and where will the standard become available? I think the answer is that the standard is made available to IFRS subscribers immediately, so it's available right now. You can download and have a look at that standard as things stand. We will also be publishing the Red Book, which is the book that deals that contains all of the standards that are coming in the future, and that will be available shortly after or shortly into the new year, specifically for all, including on the website as part of the standard issue of things that are available on the website for us. The other question we've got is whether unlisted insurance companies need to follow IFRS 17. I think that question is a question that we probably can't answer from an IASB perspective. This is very much dependent on the specific jurisdictional requirements in whatever jurisdiction you operate within. Some jurisdictions require IFRS to be used for all publicly accountable entities in that jurisdiction, and an insurance company would be a publicly accountable entity, so it would have to apply the standard. In other jurisdictions, IFRS is only required for listed companies, and in fact, in some for only consolidated listed accounts, and in that case, it would only be those that would have to apply the standard.
Okay, I've got a question here on what are the key differences between Solvency II and IFRS 17. So Solvency II and IFRS 17 have got different purposes. I think that's an important thing to start with. So Solvency is dealing with regulation and prudential objectives, whereas IFRS 17 is intended really to provide good information to investors and users of financial statements. Having said that, there are some similarities. Both are based on a current value measurement basis. Both are based on a measurement that reflects the cash flows and the risk and reflects time value of money. So there are some similarities there. I think an important difference is that the Solvency II regulation doesn't deal with the unearned profit. So that's something that the IFRS 17 measurement basis deals with through the measurement of the contractual service margin and how that profitability is earned over time.
Thanks, Andrea. Another question is how this standard differs from previous versions. Specifically, that would be the 2013 exposure draft, which is the last public version that was made available for comment. The answer there is yes, it absolutely does. During the course of the 2013 exposure process, and specifically based on the comments we received, there were a number of concerns that various people had raised about specific elements of the 2013 ED, and over the last 2 or 3 years subsequent to the issuing of that exposure draft, the board has redeliberated those particular issues that were identified and has made consequential changes to them. There are a number of changes that are important to note. I think perhaps amongst the most relevant is a change from a mirroring approach under IFRS, under the exposure draft, to under their current standard, an approach which we term the variable fee approach, which deals with contracts in which you specifically have direct participation in an underlying pool of assets. But there are a number of other changes, some bigger and some smaller, that have been made to the standard as a direct response to questions that were raised during the process of exposing in 2013.
Thank you. I've got a question here about the interaction between the IFRS 17 and IFRS 9, which is our standard for financial instruments. There's a question here about whether an entity would be able to revisit the IFRS 9 business model when it first applies IFRS 17. The transition requirements in IFRS 17 have been difficult and complex in the sense that people are moving from a very big range of different starting points, and also because these insurance contract products can sometimes last for a large number of years, so going back to look at what happened a long time ago introduces its own complexity. We've provided a number of transition reliefs in the standard to try and help people make the assessments that they need. And also, we've also provided some reliefs that allow for the reassessment of some of the IFRS 9 assessments in particular circumstances. To get the full details, you would need to look at the wording of the standard.
Thanks. We received a question on whether or not we'll have additional guidance on the fair value approach described under IFRS 17. At the outset, I think it's worth saying that, as mentioned by Andrea when she talked about implementation activities, the board does see a requirement on the standard, as with other standards we've recently issued, to be continuously involved in the implementation process and to provide guidance where we believe specific concerns arise or where there are specific problems that are coming through in the implementation of the standard. And in that space, we have decided or planned to do a number of guidance webinars and other forms of material to help people with the process. That said, on the fair value issue, the fair value in IFRS 17 refers to another standard, IFRS 13, which describes and deals with fair value and which has been around for quite a while, and is a standard where we believe people have become comfortable and have an understanding of the application of fair value. So we'd like to see how the process develops before we decide whether it is necessary to provide guidance, given the fact that it relies on an existing standard.
So I have a question here about whether we've considered the cost of implementing IFRS 17. We have, in fact, considered the cost. We've considered it throughout the process, and we've had to consider the cost in relation particularly to the benefits that we get from implementing IFRS 17. The assessment of costs and benefits are set out in a detailed effects analysis, which is available freely on our website. That's a 140-page document which provides a comprehensive assessment of where we think those costs are going to arise and why we think that the benefits outweigh those costs.
I've got a question here on what the key differences are between IFRS 17 and the embedded value determination or the embedded value calculation. I think it's first probably worth saying that in discussing this with various constituents, we haven't always seen an entirely consistent approach to the determination of embedded value. But putting that aside for the moment, and perhaps qualifying this by saying I do a comparison between IFRS 17 and market consistent embedded value. So embedded value that is updated over time to reflect the underlying activities in markets, the underlying pricing off market curves and the like. In that circumstance, the key difference between these two measures is the way that you recognize performance. Both embedded value or market consistent embedded value and IFRS 17 have at their core the determination of future obligation to pay cash and the right to receive cash over a future period. Both of these values discount those future cash flows, take into consideration the time and value of money, and both of these apply a risk margin override to that calculation. So in those respects, they're very similar. Embedded value, therefore, is very similar to what we term in the standard the fulfillment cash flows. Over and above that, though, IFRS 17 has to deal with something that embedded value doesn't, which is a measurement of performance over time. And the way that IFRS 17 does that is to capture the unearned profitability of a contract in a liability measurement that we refer to as contractual service margin. So the contractual service margin is essentially another word for unearned profit. Under an embedded value determination, that profit is recognized generally on day one and accounted for under that approach. Under IFRS 17, what we then do is we release that unearned profit over the life of the transaction. And so CSM, contractual service margin or unearned profit, is the key difference between the two measures and the key adjustment that will be needed for those entities that already internally calculate some form of market consistent value.
I'm going to take two related questions here at the moment. The first is about whether there are some insurers that might not be significantly affected by IFRS 17, and the other is about whether there are any large differences under IFRS 17 relating to short-term insurers. Compared to their existing standards, it is. So, as I've mentioned in the webinar, the extent to which IFRS 17 will impact companies depends very much on what the companies do today, and it's almost impossible for us to gauge exactly how each company will be impacted at this time. Some companies, the companies that are least likely to be as significantly affected by IFRS 17 are those whose systems and accounting is the closest to IFRS 17 as it is. So, for example, companies that already update their assumptions, already discount their liabilities, and have some kind of unearned profit recognized over time. The short-term insurers generally have a premium allocation approach which would be available for them to apply to most of their products. And it's true that long-term insurers will normally be more affected. However, even amongst the short-term insurers, there will be some differences. Not all short-term insurers, for example, discount their liabilities, and if that's true, then they will be affected. The short-term, the non-life insurers that will be least affected are those that already discount their liabilities, generally have contracts that will be eligible for our simplified premium allocation approach, or perhaps have settlement periods which are quite short.
Thanks, Andrea. We've got quite a nice question here on whether or not IFRS 17 will be standardized over a number of jurisdictions, or whether in fact individual jurisdictions will have the option to pick and choose how they would like to apply the standard. I think this is a really important question because it talks to the key underlying principle of an international set of accounting standards. The principle is that what you want is everybody across all jurisdictions reporting on the same basis. What that allows is users to more actively, more understandably, and with less effort, decide on where the optimal place is to invest in and where to withdraw their investment from. So from an IASB perspective, we would see that the IFRS 17, as it is issued, should be adopted by all IFRS jurisdictions on a consistent basis. That said, we do have some options within the standard, and those options may well be picked up in different ways in different jurisdictions. An example of that is that the standard allows an entity to choose whether or not it will use OCI to report the effective changes in discount rates over time. Now, depending on what a jurisdiction has historically done, some jurisdictions are more comfortable with the idea of reporting those changes in discount rates in their profit and loss, whereas other jurisdictions still feel that they would prefer, and they believe it presents better their outcomes, by putting those numbers in OCI. So some jurisdictional differences are likely to emerge, but the structure of the standard is such that even when that happens, all of the information is available to users so that they can compare companies across these different jurisdictions. We think that's a really important part of having an international set of standards. I'm going to deal with another question too, and it's a couple of questions that we're pulling together to discuss in a single way, which is how we see the role of actuaries in the process of adopting the standard. Now, I think this is a really important question because clearly IFRS 17 is an accounting standard, but it's also clear that the determination of things like fulfillment cash flows is going to be extremely dependent on the outcome of actuarial valuations, actuarial calculations, actuarial determinations and processes. So we do think that actuaries play an incredibly important role in this standard. We think that they will be a very, very important source of the data for the finalization of results under this standard. Because of that, we think that it is really important that actuarial teams and accounting teams in implementing the standard work very, very closely together. And we expect to see that, and we've certainly heard that as we've worked through the process. At the same time, I think we also see this as a standard written for accountants to use actuarial data. We expect over the next 18 to 24 months to engage with the actuarial profession on some issues that they may have, but the focus of the TRG is going to be on accounting issues. And the focus of the people that we would expect to participate in the TRG is expected to be accountants. And that is because it will be, at the end of the day, the accountants who are implementing the standard, drawing on the information that they get from actuaries.
I have a question here about how long the European endorsement process will take, and I suppose that's one aspect of, there will be other processes in other parts of the world as well. The European endorsement process, though, is one that we have the most data on, I think. Looking back at recent standards that we've published, I would say that around 28 months 24 to 28 months seems to be a reasonable average. IFRS 15 took 28 months to endorse between the publication date and the endorsement date. IFRS 9 similarly took 28 months between the publication date and the endorsement date. And those are probably standards which are as big as the standard in terms of how long that process should take.
Two more questions. The first one is whether we think there's any potential for the standard to be reopened as a result of the TRG discussions. I think at the outset my answer would be no. The objective of the TRG discussions is to specifically deal with implementation issues in a way that helps people understand what the intent of the board is and help them work through some of the processes that others may have worked through before they've got there. So really the TRG process is about providing educational support, providing a thought process support to those who follow the discussion, and also to give the opportunity to have discussions about different ways that you might think about specific issues. Clearly, though, it's very difficult for us to anticipate fully what the outcome of the process is going to be, and we have said specifically as part of our initial introduction to the TRG is that we anticipate that there may be circumstances in which the TRG might refer something to either the board or the IFRIC for further consideration. But I think at the outset we would say that we don't expect to make changes to the standard. We'd expect the standard to remain as is. Another question that we've got is, how do we expect the standard will impact on mutual insurers? Well, clearly mutual insurers are insurance companies. And mutual, perhaps more importantly, mutual companies issue insurance contracts. That means that insurance contracts are the subject of IFRS 17, and so mutual companies that apply IFRS will apply IFRS 17 to those contracts that they have on their books. A slight complication for mutual companies is that many of them don't have shareholders. What they essentially have is different classes of policyholders, and we have in the past discussed at the board table how they would deal with this and concluded that there are several different ways they can think of to present the outcome of their determinations on insurance contracts. Specifically, we think that it would be advisable would be good disclosure practice under the requirements of IS1 for a mutual insurer to consider dividing up its policyholders between those that are the most residual and those that are not. And there's a little bit of commentary on that in the basis of the standard.
So I have a question here about the relationship between IFRS 15 and IFRS 17. I think one of the main features of IFRS 17 compared to accounting models that had previously been applied for insurance activities is that IFRS 17 applies to insurance contracts, which meet our definition of insurance contracts, rather than to entities that issue insurance contracts or that are defined as entities falling within the scope of some sort of insurance activity. So what that means is that IFRS 17 applies to contracts that an insurer issues. They apply IFRS 9 to financial instruments that they have, and they would apply IFRS 15 to contracts with customers that don't meet the definition of an insurance contract. There is an important interaction with IFRS 15, though, in the sense that the thinking about recognizing the profit as it's earned over time is consistent with some of the thinking that we've got in IFRS 15, and that the difference is really that in IFRS 17 there is more updating of information because this is an industry, the contracts that are affected have much more, they're longer term in nature and they are more affected by assumptions that could be updated.
I had a question on one of the issues that has been discussed a fair number of times by the IASB at various board meetings over time, and that is the level of aggregation that you apply when you're thinking about IFRS 17 for the determination or the calculation. I think there are a couple of points that are worth making at the outset on this. Because of the nature of fulfillment cash flows, which is measuring future cash flows, discounting them at a rate that is relevant to the underlying liability and adjusting them for risk, we think that the base fulfillment cash flow calculation, you get the same outcome whether you're determining it for one contract or for every single contract on your book. So at a fulfillment cash flow level, the level of aggregation is left to the entity to decide, and we presume that the entity would apply that based on what their existing systems allow them to do. The second element is CSM, as we discussed. This is one of the core differences between IFRS 17 and, for example, market consistent embedded value. CSM does require an entity to identify a level of aggregation for its contracts. And the approach that the IASB has followed for this is a top-down approach. So you start with a portfolio of contracts. A portfolio of contracts is contracts with similar risks managed together. So essentially looking at the way you as a company manage those contracts when you start with a portfolio. That portfolio is then subdivided based at inception on the expected outcome of the groups of contracts. And the way that you do that is you identify within that portfolio whether there are sets of contracts that are expected to be either onerous or expected to be loss-making at inception, or expecting to be near onerous, so not resilient, and then any other contracts. So essentially identifying three broad groups at inception of contracts. You do that based on the information that you have available at inception of the contract, so you don't have to go out and find additional information, and you don't change your view on those three groups over time. It's set initially and maintained throughout the life of the contracts. What the IASB expected in making those three determinations is that in the vast majority of circumstances, at inception, insurance contracts are issued, or insurers issue insurance contracts that they expect will be profitable. So very much the two groups dealing with onerous and non-resilient are likely to be, in many circumstances, null groups or zero groups. That's the first division you do. The second division you do is been variously described as cohorts. What the standard says is that you can't include contracts in a group that have been issued more than 12 months apart. So that requires that an insurance entity think about dividing up its portfolio into at least, or it's dividing its groups into at least 12-month slugs. The standard does allow you to break it up into smaller groups if that's what you do from an internal perspective, but not more than 12 months.
One of the questions here is noted that we have within the scope of IFRS 17 investment contracts with discretionary participation features. So these are investment contracts that don't have any insurance risk. They don't meet the definition of an insurance contract. However, their features have much that is in common with insurance contracts in terms of long duration, high acquisition costs, uncertainty of measurement. And so the IASB has decided to include the investment contracts with discretionary participation features that are issued by insurers within the scope of the standard on insurance contracts. The question is about how we plan to treat the discretionary participation feature, and in particular whether the asset return will have any impact on the discount rate. So because these investment contracts with discretionary participation features are within the scope of the standard, that means that they'll be measured in the same way as insurance contracts, which is to say it will be measured based on the expected cash flows, adjusted for the time value of money and for the risk in the contract. The discount rate used to adjust the cash flows for the time value of money is, as for all contracts in this standard, a discount rate that reflects the characteristics of the liability. And what that means is, to the extent that the asset return has an effect on the characteristics of the liability, for example, to the extent that the asset return is simply passed through onto policyholders, then that will affect the discount rate which would be appropriate for those asset returns. So there could be an impact if that's the case.
Thanks, Andrea. Another question has been asked about whether or not, or is based on the expectation that the IAA and ESMA are likely to issue additional guidance around IFRS 17. And the question is essentially asking how it is that the IASB expects to be involved in the process, or will in fact the IASB be involved in the process. We've had some experience in a very similar space with IFRS 9. In the IFRS 9 space, the bank regulators in particular looked to issue additional guidance. And the way that we worked with that was to stay continuously engaged in the discussion that we had with the discussions that were had by the regulators, to make sure that what was coming from the regulators was consistent with the standard that we had issued. As many will know, IFRS standards, and IFRS 17 is another example of this, are principle-based. And that does mean that it allows a certain amount of latitude in how specific requirements are applied, including, in this case, perhaps specific actuarial determinations and the like. What we saw with IFRS 9 is that regulators specifically became involved in helping banks consistently apply some of that terminology that we'd included in the standard. As mentioned, we expect very much the same type of thing to happen. What we did with IFRS 9 was stayed engaged with the Basel group to make sure that we understood where they were going, to give them feedback on their various comments, feedback on their various views, and we would expect to do something very similar in the space of IFRS 17.
There's some interest in the simplified premium allocation approach, which is included in IFRS 17, and some have asked for examples of contracts over 1 year that would be eligible for the premium allocation approach. So first of all, the premium allocation approach is intended primarily as a simplification to the main accounting model in IFRS 17, because we know that there's a method, the premium allocation approach is a method that can produce similar results in particular circumstances. And those circumstances are really where the updating of information doesn't have much of an effect, because largely the information doesn't change very much from period to period. We have allowed a safe harbour of contracts with a coverage period of less than 1 year, and said that if you have a contract that's got a coverage period of less than 1 year, that automatically qualifies for the premium allocation approach. But we've also maintained the principle that if an entity reasonably expect that the simplification does provide a measurement of the liability of remaining coverage for the group that's not materially different from applying the full IFRS 17 model, then those contracts could also apply the premium allocation approach. And the eligibility for that will need to be assessed on a contract type basis. Somebody has asked whether any life insurance contracts might qualify for that. For example, a short-term life policy might well qualify for the premium allocation approach. Similarly, if you've got a contract that's over a year, then that might qualify for the premium allocation approach as well if you think that there's no significant change in risk, that the cash flows are pretty stable, and that the discount rates are also pretty stable. So those would be the sorts of contracts that would qualify.
Thanks, Andrea. We've had a question on the fact that revenue under the standard is required to exclude deposits. And the question is whether that would apply even if it is not clear from the premium or contract what the deposit element actually is. And the answer to that is yes, absolutely. The IFRS 17 approach is an expected future value approach. What it requires an insurance company to do is to assess their expectations of payouts under an insurance contract, and on that basis determine what the deposit element is versus the risk element. So I'll give a simple example there. A number of life contracts that are available include some form of surrender value. The surrender value component is essentially like a deposit, because what happens with that surrender component is it is payable to the insured no matter what the outcome of the contract is. So you will receive it if you meet the conditions of the contract. If you pass away, you will receive at least the surrender value, plus in addition a risk element over and above that. But if instead you surrender, you will just receive the surrender value. So we would consider that surrender value to be the deposit element of this type of contract. And you would do that even in circumstances where that is not an explicit separated out amount in the contract. What you're looking for in making that assessment is whether there is a scenario or circumstance in which you expect that you could pay nothing. In other words, an amount might never become payable to the policyholder. Also received a question here which relates, I think, to a previous question I answered on level of aggregation, which is, do we really require separate disclosure for onerous, near onerous, and profitable groups? And the answer to that is no. The grouping of contracts into these groups is primarily about the recognition and measurement, particularly, of those contracts over time. So as I mentioned previously, we have an unearned profit element in IFRS 17. That unearned profit element is recorded as a liability in the balance sheet, but sometimes contracts will be written where the unearned profit is in fact negative. You expect to make a loss on the contract. And consistent with other standards, IFRS 17 requires that you recognize that loss immediately. You don't delay the recognition of the loss over the life of the contract. So what the grouping allows you to do is identify those contracts that have a loss at inception and therefore recognize the loss, and those contracts that don't, and in the second circumstance to spread that unearned profit over the life of the contract.
I think we're coming up close to the end of our time, so I'm going to take one more question, and then I'll invite Darrel to take one more question, and then I think we'll wrap it up. The question I'm going to answer is about the definition of direct participating contracts, which is a particular type of contract that's dealt with in IFRS 17. The question is whether if there's any specific threshold for substantial, and I'm not going to go into all the details of the criteria on this webinar. However, I would say that these direct participation contracts are contracts that we think substantially are investment-related contracts. So in assessing the criteria for that, including whether or not there's a substantial amount of the interpretation of the word substantial in two of those criteria, that needs to be done in the context of understanding whether the contract as a whole seems to be an investment-related type contract, because the model has been developed specifically for the features of investment-related contracts.
The last question that I will deal with is a question on whether or not there is convergence with the FASB in the context of IFRS 17. As many who have followed this project for a number of years will know, we did have joint discussions with the FASB over a period of time, but in the end concluded that the starting points of the two sets of standard setters was too different, and it made sense for us to continue the process individually to complete the process to where we are. The FASB starts with a number of specific standards for specific types of contracts that are already operational and work in the space that they're in. What the FASB is looking at doing at the moment is to update some of those standards, and in updating some of those standards, they're moving toward a model that is similar to IFRS 17. IFRS 17, on the other hand, has taken the approach of a single encompassing standard that deals with all insurance contracts in the same way. Although that means we have some similarity between the two standards, I don't think we could call them even directionally converged at this stage.
Okay, so all that remains for me is to say that thank you for listening to this webinar. Hope you have enjoyed the slide presentation and you've had some of your questions answered. We will be producing more information over the coming months, so stay tuned to the IASB website for further information. Thank you.